So before I came on, I thought, certainly by now with all of the market talk and potentially client conversations and the hype about ESG investing, all of you know what it is. And before I came up, Josh whispered in my ear, you'll be reassured to know that none of us know anything about this. So I will keep it simple, and we'll go from there. Forward. So generally, what is ESG investing? The way we can, at the most basic level, describe it is the systematic integration of environmental, social, and governance factors into the investment process. And why would we do that? By investors taking a look at these factors, they indicate risks or opportunities to consider in their investment process, which can affect returns, mitigate risks, and also align according to their investments, or their mission. What I don't want to do is really focus so much on the mission side because it can be misinterpreted as green investing and only taking into account the environmental decisions per a certain values-based. There's very much a case here for taking a look at these factors in order to, as I said, consider risks and opportunities so that portfolios could outperform a traditional portfolio. So just to level set here, the overall umbrella category is sustainable investing. There is no standardization yet of terms, so sustainable investing is the one that we'll stick to embrace, to capture all of the different types of ways you can go about ESG investing. Now, the three big categories that entails are exclusionary screening or negative screening, which has formerly been known as SRI, socially responsible investing. But again, because of the confusion and the way terms are used interchangeably and potentially mistakenly, the term exclusionary screening is probably the best to use. On the further right side, so that's avoiding exposure, and the further right end of the spectrum is impact, which is seeking with intention measurable outcomes in a portfolio. And right in the middle, where we're focused, is ESG investing, which again is just identifying companies' policies and procedures that can contribute to information or signals about their practices that can better inform investors. Examples are along the bottom. So in the first negative screening example would be ex-fossil fuels or excluding a specific country or set of values such as Catholic values. An example of ESG investing is taking into account, let's say, best in class, so the top 25%, or as Vince is going to explain, our two ESG ETFs that consider the top 50th percentile of ESG performing companies. Is that a phone?
No, it's a chime to get people back.
Oh, is it? Okay. Am I being caned off already? So you've seen this chart, and this is the U.S. This is in the U.S. the growth, and the 30% returns have continued basically since 2007, and you can see a tripling of assets from 2010 to 2016. So this it might be a little confusing. The gray is actually overlapping assets, so that's been stripped out from the total. So while there's $8.1 trillion in ESG investments, there's actually a total of $8.7 trillion invested either using shareholder resolutions to get at specific outcomes or ESG strategies. So the gray is just the double counting, and that's been taken out. What this translates to is of the 40 trillion invested assets in the States, $1 in $5 are currently being invested in ESG. So for the naysayers that say, there's a lot of talk and there's no dollars that follow, you can see from the numbers and that continue to grow that in fact that is not the case. And the breakdown here is essentially showing that the majority of assets have been currently institutional, with a smaller portion in the mutual fund space. There's 1.8 trillion currently invested in mutual funds, and this is the breakdown you can see here. So 1.7, that was as of November, invested in mutual funds. ETFs, so ESG ETFs, which is quite relevant for today, as of November was about 3 billion, and as of yesterday when I looked on ETF DB, it was about 2.5 billion. So that's come down. So of course there's fluctuations. But the point here is it might be small relative to the overall market, but retail dollars follow institutions. And the years I spent at BlackRock talking about this space, it was quite compelling to see how the client conversations changed from philosophical, tell me about this thing I'm hearing about, this, mega trend. Some European clients would come to us and say specifically want to exclude weapons or fossil fuels, or they have a specific mandate in mind. To others saying, tell us more about it. Tell us how you see it, because as we've mentioned, there's no standardization in definitions, let alone how you go about it. I did have to look up the expression, there are many roads to Rome. And in fact, there are many roads to Rome, and the history of that expression basically summarizes that there are many ways to go about ESG investing. I'll have you know that the Romans did build a lot of roads to Rome. They were the first to, this is research late last night, they were the first to add mile markers, and the reason they did this was to hinder all of the different provinces basically bolstering attack against the Roman Empire. So there are many ways to go about it, but ESG investing is a part of the daily conversations that we've been having with clients over the past years, and if you haven't had these conversations with your clients, I'm here to help inform and educate and get you excited about this trend that is certainly coming. So why now? Certainly there's been SRI for years, for 20 years, and conferences, I was talking to John last night, I've seen some of those that have been in the industry for years, I'm talking 40 years, that were involved in the 60s, coming from more that organic, let's say, angle, that are happy that finally this has become mainstream. So we all know about the global challenges. 18%, no, it's 28% now of the US irrigated land has water issues. I read 3 times the amount of hacks, security breaches have happened from 2010 to 2014. And there's no shortage of scandals from Wells Fargo, VW, which I can give an example about, Valiant, just to name a few. We can see that these types of issues are accelerating and need to be taken into account when looking at the value of a company. Shifting demographics, we've all heard about the millennials that will be driving our wealth in years ahead, and the control shifting from, or equalizing, so that women who are very interested in sustainable investing will control 66% of consumer wealth in the next 10 years. So from foundations and endowments who are shifting their missions and their policies, supported by rulings such as the IRS saying that foundations can now invest according to their missions, and it falls within the definition of charities, to the Department of Labor saying that it is now a part of fiduciary responsibility to consider ESG as opposed to conflicts with your fiduciary duty. These are regulatory changes that are coming that are providing a really good foundation for moving and progressing ESG. And certainly corporations are under pressure. So I have a good example of a client that I spoke with probably 3 years ago now. And in our quarterly reviews, we would bring up some of these trends that we were seeing, because they were always interested in what other clients were up to. And we talked about smart beta, and at that time currency hedging, synthetic overlays, and I'd always bring up ESG. And this client was based in the Midwest, a few miles from a coal mine, and they said, don't talk to me about ESG. Our city's pension plan is supported by the coal mine down the road. So I said, noted. I'll not be talking about that in the next. So fast forward to the next quarterly review, and I skipped over the topic. And then 6 months later, in the next quarterly review, they said, our participants have been asking us why, or how do we view ESG? Do we consider it in our investment? So it's not, do you believe in it, which I think is potentially a dangerous conversation to have because everyone has different beliefs, but how do you consider this in your investment decisions? So because of that type of pressure, they then said, okay, tell us about it. Give us something, And they went from a critic or a naysayer to say that this doesn't have a place for us, to saying we need to be more educated so that we can talk intelligently to our clients, or for them it was participants. But this translates to to the conversations here that you may be having, and being armed with statistics, a view on how one might go about considering ESG, without saying it's right or wrong or there is one way or the other, will certainly be beneficial. So those were all the drivers that I see, the main drivers of why now, why is ESG so popular, why is it becoming this massive part of institutional and pensions and foundations portfolios, but it's also the access and availability of data, which of course has helped drive it. So from more companies reporting, as Sharon mentioned, 80% of S&P companies are now publishing reports to the types of measures you can get access to on Bloomberg. You can even see on Google Finance, there's a little CDP score that has been out there for a couple of years, which tells the carbon disclosure rating of a portfolio. Sustainalytics, MSCI, all of these big, reliable experts in the field have been doing very comprehensive and methodical they've been taking into account these practices and being able to, and are publishing them, so that the data is becoming more available, and with access comes conversations, and then analysts being able to, to look at the data. And then the fourth point is that engagement. So companies reaching out, asking questions, which is currently being done at this firm by the PMs. So here's the question, can it deliver returns? And there's been no shortage of academic and empirical studies in recent years showing that, in fact, the ESG investing has the potential to not just meet market returns, but outperform, as well as deliver lower volatility. So sustainability is correlated with lower volatility. In Morningstar, they did a study, and it looked at 1,800 mutual funds listed in their database, which they called socially conscious. And it showed a correlation, as I said, between volatility as measured by standard deviation, but also their own proprietary Sustainalytics volatility score. And this persisted across, so the types of scores, the types of risk, and then time periods. So on a trailing 3, 5, and 10-year basis, they found this correlation. Then the performance question is, it hasn't been, it's not a slam dunk, it's not 100%, because, as I said, there's many ways to go about ESG investing, but certainly there is no negative hindrance from considering ESG in all of the studies, and there's many studies out there showing an outperformance. So there is opportunity to deliver alpha. Sharon did cover this study, but again, it's compelling because it shows the high percentage of, this was a study conducted by Oxford, and they looked at over 200 studies, so it was very broad and robust, and they took into account cost of capital, operational performance, stock price performance, and you can see in the large majority, these were quite favorable by looking at sustainability. So there's no shortage of studies. I can certainly provide more examples for you if that is of interest to help tip the and convince. But there's also a white paper which dovetails with this deck that will be released, actually has been published on the web. So you can reference that because there's several studies listed there. These are examples of ESG evaluations that one might consider in their analysis. So on the environmental side, looking at a company's use of green buildings, or most importantly, GHG, greenhouse gas emissions. On the social front, labor management practices play an important factor, health and safety, quality of products. Interestingly, these are all factors that VW was flagged for prior to the scandal. And I think it might actually be a good time to talk about ESG in play. So an example of I'm asked many times, well, so let's look at our fund, even the MSCI ACWI ESG took out VW in May 2015. The scandal occurred in September 2015. So in our global ESG ETF, VW was not held. Why is that? Because they had been tracking for years and years VW compared to its peers in the consumer discretionary sector. And prior to May, there had been flags on bribery and fraud, on their quality of products, on governance, and then their collective bargaining practices. So by monitoring closely across hundreds of different variables, MSCI was able to say, hey, they are not, now, because there was collusion, because there was actually lying and withholding information, MSCI couldn't say, oh, they're lying and they're about to have they're cheating, and they couldn't discern that because but these other little flags started creeping up. And they dropped out of, again, in however many months before, where that was 4 months before, 4 months before, they were able to say, this company, compared to its peers in the sector, is underperforming. So it was ranked 6 out of 8. Their rating at the time was BBB. So Vince will get into the scoring methodology. That BBB dropped to CCC, which is the lowest potential rating. And then when the scandal broke, so it wasn't held in the universe, was not held in the index, so the fund was not impacted. And then after the controversy occurred, that rating dropped to CCC, and they were flagged, the worst, the most severe flag. So that's a case in point of tracking these types of data points, which are non-financial, but that can act as signals toward the future performance of a company. What this all translates to is opportunity for investors, and by default, opportunity for everyone sitting in this room to have these conversations and to be able to offer, now that we're excited, now that we've launched the ESG ETFs, to be able to say we have a solution. So for those that might be interested to hear about this, this trend and this way of looking at the universe, it is essentially taking non-financial factors, overlaying with the traditional fundamental factors to provide more information. It's a different way of looking at the universe, but it's just additive. And there is an opportunity here to have these conversations, open up new conversations with a younger potential database of clients, and to be able to say, hey, we're in the game, and we understand the risks and opportunities that ESG presents, and provide not only current products, but as Sharon has mentioned, a future spectrum of viable products. So to get into the details of methodology, I will pass it over to Vince to talk about the 2 ETFs.
Thank you. Nice job. Just show me how you changed. Thank you. Okay, thank you. Let me just add a little bit. I know, some people have brought up, why are we doing ESG? And aside from this great work that Cara has done, let me give you some practical. Some of the work I did when I was at Citigroup, I had Ohio Treasury as a client, Pennsylvania. I had foundations, endowments, and I will tell you, with these committees and boards, everybody wanted to allocate money to some type of strategy like this. I mean, the money is sitting there. The biggest problem was nobody could come to a consensus what it is, because you have all these diverse views on these boards, and I don't want this, I don't want that, and no one could really come up with a strategy, and we would try and bring managers in to customize things, and it was a real workout. But now, with this kind of a strategy, we have these third parties that have these very transparent screens that are available. You're going to reduce that hostility. So I believe there's money sitting out there, particularly in endowments, foundations, and particularly public funds, where you can get some large allocations to strategies where they can see this more transparent and kind of a neutral. When we go through this Sustainalytics, you'll see, which I really like the Sustainalytics group, the kind of transparency. They use like roughly, I'll go through it right now. We'll start going through the screen. So what we've done with Sharon and Cara is we decided let's do an ESG screen and we have a domestic product and then we have the global product, but we start on the domestic product with the first step is the broad universe is the S&P 500, which is what we do. We like the strategy. It's an investable strategy, and we begin our screen there. So we use the S&P 500, and We have the leverage of what they provide us in terms of the screen process, which we're all familiar with. But then step 2 is we will use the Sustainalytics, which has a proprietary screening process. I don't know if they have it here, but there's 146 metrics. Now, they don't apply all 146 to every single company, but it's kind of allocated, is it appropriate for that company? And they have these analysts that will go out and research people that will measure. So you can't, it's really hard to have like people that have an agenda. If they don't like energy, we're going to find a way to kick energy out. No, it doesn't work. It's far more transparent, and the metrics that add up give us a really good reading on things like carbon and emissions, but they also have a positive effect, this screen, where if a company's spending, if it's an energy company and they're spending a lot of money on trying to develop alternative energy strategies, they get really good points for that. In this strategy, I believe one of the things was in there, that, like in Philadelphia, we have the Comcast building that has this gigantic, what do they call when they're taking in energy? Half the building is taking in energy. They really don't use electricity in this in the product. They get points for the way they build their buildings or the way the buildings they're in. So it's a really comprehensive screen. So what we do is we take that 146-point screen and it's applied. Well, we don't apply it. Sustainalytics applies it and gives it all these screens a rating. All these companies, all the constituents are rating, and then what we do is we take the top 50 percentile in scores. And that top 50 percentile, you would think brings us to 250, but we end up with about 270 or something in terms of the scores, because what happens eventually, other companies move in because we eliminate companies that have what we call controversial scores of 4 and 5. And I'll give you an example, but I know Cynthia probably doesn't want me to use names of companies, but you'll see the former chairman on TV today. And the problem, it's a great company in terms of all the other systems, but its controversy score gets up to around 4 or 5, mainly in my memory of it all is their potential for some of these oil rigs that could collapse on them, or, you know, so it has some controversial scores around the drilling process. But on all other aspects of the company, it's great. But some of these companies move up. Apple, I'm sorry, just moved into 4 or 5, and they got booted out. But there were issues around some controversial scores, and they're pretty neutral reasons. And the screen is very, it's intriguing. I don't know if all this works. Okay, it really sounds good. And what we saw with Cara, you know, these studies actually are showing some important things. But here's the key of what we're doing. We're going to find out, because then our third step is we revenuate them. And guess what? If they're not making money, they're not going to make it with the revenue. They're going to just slowly move down the list, and they're going to get booted out of there. So we now have what appears to be a really good screen, and a lot of data saying that these type of screens on a company actually give us a better basket of stocks. And we'll say, because this is new, when we did the back testing, this stuff is all brand new. We couldn't get much beyond 7 or 8 years. But we're beginning to see some of the returns. Oh, by the way, the last 3-year returns, I compared this to RWL. RWL outperformed it in a 7-year period, a 5-year period, but has underperformed it. It has outperformed RWL in the last like 24 months to 30 months. So I don't know what that is, but it's there. And I'm not there to compare one or the other, but we are seeing things happen there. I will tell you, by revenue weighting it, and you'll see in the breakout sessions, the performance is better than all the other ESG screen products that are out there. So we think we have 2 things here, right? We have the really neat product that screens this down, and then when we add the revenue weight strategy in there, we think we actually are going to say, are you going to deliver? Where's the beef? Does this ESG really work for these companies? And that's why I think we really have, and by the way, I think it's great for the brand name of Oppenheimer to say, hey, we have this thing, we're thinking about these things, and that, you know, we really did a nice job creating a product that actually has really, really good performance. And I like the whole concept and the strategy with this. We're going to go into more in the breakout sessions because we're trying to avoid spending too much time up here with this. But real quick, again, here's some of the important points. This materiality in terms of the Sustainalytics, is it material to the product? Is it material to the sector? Is it material to that company? So we're not applying undue and unnecessary screens on a company that just cannot pass these things under normal conditions. So the infotech sector is treated different than the energy sector. So this thing is designed to be more positive and to create what companies are doing positively and not punish companies unless they're doing something that puts them in that 4 or 5 scenario. Comparability, which I just discussed, risk-based, and it's forward-looking. Is what they're doing, is it really looking towards the future in terms of their own product development, not whether we like it or not. Is that product going to be accepted in the field? We heard a lot about the millennials. I don't know if the millennials are going to invest in these products. They may, but what we do know, because they don't really have their money yet, but what we do know, they're very different in what they buy. I mean, I just look at my kids. Nothing I own do they own. And it's just completely different. And so we do know they're buying products out there. We'll see what happens when they get the money. Transparency, as I said, I think it's key. And then we have the controversial score going from low, moderate, significant. We eliminate 4 and 5s in the screen. Let me just jump to the global product. In this product, we use a different screen process. The MSCI has been running, they've been in this longer than Sustainalytics. So they've got a really good screen. It's a little bit different. I couldn't tell you which one's better. I kind of understood the Sustainalytics a little more because there's more detail in it. But I'm sure Cara could have more viewpoints on that. I'm not really an expert on the screen. I'm depending on the quality. What I want to give you is a well-screened basket of stocks, and then we'll revenue weight it. But we go through almost a very similar step. We have the MSCI All World Index Universe. We use that. There's an added step in here that we're going to be using additionally. So we ran into a slight little problem when we hit the emerging markets with our rep. We knew this was out there before when we were trying to create it at our own firm. But in the emerging markets, as many of your emerging managers and your internationals will tell you, the data available is nothing like what you can find in the U.S. So it's very sketchy, and we were missing lots of data in that index. So in order to kind of reduce the uncertainty around the data, we had been toying around with the Sharpe ratio. Okay, so just real quick, the Sharpe ratio, I'm going to give you a real 50,000-foot view. Here's your return as the numerator. The standard deviation is the denominator. If that numerator is expanding faster than the denominator, we think we're picking, and this is important too. It's got to be, we got to move the data up quickly every quarter. We believe we're obtaining information from other investors about that stock, because what happens when we screen and we take the top 50% of the Sharpe ratios, we end up, our data goes from about 58% reliability in the data we have up to 95, 96%. So the data we have is very, very reliable when we just take that top 50% by Sharpe ratios. But we've really been looking at that tracking how that Sharpe ratio expands and what it means in terms of giving us really good information, forward-looking information about the performance of that stock. We'll go into that more later. So, we have that. We have the MSCI screen process. I'm going to go through that in a second. And then the fourth step is after we do all those screens and bring it down to about 490 stocks, then we revenue weight it. And then, we move on. We use a 12-month Sharpe ratio, but it moves up every quarter. So it's a trailing 12-month Sharpe, moves up a quarter just like the revenues. Everything stays in line. And what we're trying to do, some of the studies we have, Sharpe ratios become dilutive and not reliable the longer term you use them. So Sharpe ratios are really more effective using very short-term moves in those Sharpe ratios that help give you that predictive nature of the Sharpe ratio. On the screen here, it looks almost like Moody's or the way S&P used to do. I guess this would have been S&P's rating system. Instead of the controversial scores or even the scores that we use, here's the MSCI approach. You have the analysis in terms of governance, the ESG factors by industry, a very similar allocation by not trying to apply certain criteria to various industries that could not possibly pass some of the criteria. So they kind of massage that data so it doesn't negatively impact screening. It's more promotional. Okay, the more you do with this in your sector, the more you will reach these higher levels. So it's broken down into AAA, AA, A, triple B, double B, B, and triple C. So obviously what we do is we eliminate all the B and triple C, and we just take the top half of these products and using the ESG screen in addition to the Sharpe ratio and then the revenue weight. But that is kind of like the 50,000-foot view here. I wanted to kind of just leave a lot of time here for questions because I figured that people would have a lot of questions around the screen. And that's it.
Thank you. Okay. Oh, so that I did, that might have been an older question. So corporate scenarios such as with VW, where if ESG was in place. So for example, as I said, the VW was not held in the global ETF, and that was because the information was provided. Now MSCI does not claim foresight. They don't say we knew what was happening, but what they were able to discern was that company was lagging in governance. As I said, there were indicators of bribery and fraud, collective bargaining, and what's the other piece was, well, I guess governance was that, and that showed that they had some issues. There were some issues, and they weren't able to point to specifically that the company was cheating on their emissions ratings, but they were able to say that compared to the peers, this company has dropped down. So as a result of that, based on how Vince explained that the ratings are very much sector-based because every sector, of course, has different and more relevant factors. There's 60 to 80 factors considered per industry, and based on those ESG factors in consumer discretionary, VW was ranked 6 out of 8 and had a low score. So because of the, I wouldn't say predictive nature, but really more the data to capture real time how the company was operating, their policies and practices. Oh, it was product also in their product quality. That was the other piece that was flagged. But because all of these flags emerged, their rating was dropped, and as a result, they dropped out of the index and therefore out of the portfolios, so that there was not a negative impact on the portfolio. Does ESG investing lead to better investment results? You can't say that 100% of the time. There is enough studies to show that it, can you keep the question up? There was a second piece to it. There's enough studies to show that there is not a negative hindrance on performance by including ESG. Now, there is an element, as much as you can be provided with robust data that is very reliable, there is still an element of subjectivity and interpretation of the data. So it really is up to the manager or the investor that is taking into account the signals, so to speak, of whether or not they actually use it well. And as more data is to be made available, the issue of materiality will be raised. And out of all this information out there, what are the material factors that we should consider in order to determine whether or not we keep this company in our portfolio or remove it, or underweight or overweight it, or there's different ways to go about it, if you want to add to that.
One of the things that I had noticed in any of these type of screens in the past was they tended to, and even this to some degree, but this has changed it, punish the energy sector. And the energy sector is core to our whole livelihood, and it drives revenues and it drives returns. So one of the things about this third-party screen that I like is that it's positive in nature. Again, the one company I talked about that's not in there is only in there because of an issue around some oil rigs and that they hit it. But there's other energy in there. So in this case, we believe we're outperforming a lot of the others, even though we had some negative returns in energy over the last couple of years. The recent rebound in energy has been very helpful, and that in the case that we have here, we're not going to be not exposed to energy. And in fact, there's no sector that we're not going to be exposed to. But in some of the other kind of draconian screens where they're negative, I believe, that type of thing will occur, where the only thing you can own is information technology. So I think what we're creating here is going to allow us to own companies that are doing things and thinking about things of the reality of delivering real products to us now that we need, but also are trying to improve their product development and their companies to give us better products in the future. And that's what I think we have with the way this Sustainalytics works and the MSCI, this third-party screen.
Yep. Okay, so I'd echo that. The second point was, why have they underperformed? And I think, to Vince's point, draconian was a good word, or very simplistic ways of going about screening. So by just cutting out a sector, we all know that limits diversification and changes the risk-return characteristics, and is not the best way of going about it. So while there's a place for negative screens, specifically for companies, foundations that have a particular mission or have a value set, they invest according to that mandate. And they may not be looking for returns as their primary, as their primary driving factor. But I would say for, even the KLD, which is the longest track record out there, it's hovered around the market return, around the benchmark. It hasn't been outstanding in terms of performance. But, as methods and information evolves, we will get more intricate ways of going about assessing the indicators and improving performance by discerning which are the material factors. Again, in your experience, do you see a proliferation of ESG asset flows centered around metro and coastal areas? Do you want to?
I don't mean to laugh, but it just reminds me of the election. It really goes to that, and I think that I do. I think that we and it's based on what I said before. I don't know what the millennials are going to do. I know if this was 1975, my generation would have sounded much like the millennials. But now that they're my age, they sound a lot more conservative. So we don't know what they're really going to do. But what we do know is that their buying habits are very, very different, and they're very conscious of the whole ESG concept. And I'm more focused on their buying habits and what impact they're going to have on companies. So I think right there, and that is heavily on both coasts, I think, and large metropolitan areas. I don't think you're going to find a lot of, and it's just personal opinion, you may, in the center parts of the country. But when I travel around, I don't see it there. I see at the institutional level, in the endowments, public funds, and even insurance companies that are really focusing on this. So it is a narrower market. I'm not here to tell you that it's a broad market, but I am here to tell you it could become a very broad market because of it. We have more information nowadays, and people, I know my wife, when she shops, I still shop the way I did 30 years ago, but she's more conscious of what she's buying, and my family are more conscious of what they buy today. And I think it's on the buy side, not so much the sell side that the difference is going to come in terms of why ESG is important, if that makes sense.
It's a much reduced universe.
Yeah,
Do you know
yeah, I think so. I think that's the only answer. It's a reduced universe.
Yeah.
Yeah.
To pick out the best. So there's still sector constraints. There's no country. There's you can speak to this better. There are some constraints, but still maintains the same risk-return characteristics of the parent index. And of course, by stripping out not only the top 50th percentile of ESG funds and then the top 50 Sharp, the ACWI goes from 2,700 down to a few hundred.
Yeah, about 400. We bring it down. Eventually, it gets down to about 495 versus around 260 in the domestic strategy. The models, ESG models. The only thing is we have the screen process. We have not created ESG models. Did I read that question right? We don't have any models available yet.
I think the question might be, how would one implement ESG across a full portfolio?
Oh, okay, yeah.
And if that's the case, of course, we have the global and the domestic as two core holdings in the portfolio. And as discussions evolve, as we get more feedback from clients, we'll certainly take that into account and be able to provide, a longer term and full portfolio solution.
Yeah, I do think it's a product that in the overall model is there for boards that want to make a statement about what they believe in terms of really this whole ESG, environmental, social, and governance. It's a way for them now to make a statement. I mean, that's where we are now. But I believe that can expand if, in fact, this ESG screening and promotion of this type of behavior within corporations creates better products over time. That could expand on us. But it is new, and I think the key here is that we're making it available to clients that do want to make a statement. And I know, and I agree with it, it's not a broad base. Not all the investors are going to want to do this. But it gives us, Oppenheimer, the ability to say, hey, we're thinking about these things, and if it becomes important more than it is now, we'll be there.
Yeah.
We'll be ahead of the game.
If the demand drives it, certainly. And you can see that shift happening, more and more products. And I think that is the trend for 2017 and ahead, is more types of niche products that can be used as, core substitutes. And clients will have the opportunity, even in their plans, to be able to swap out for the ESG option. And eventually, to have, again, a full portfolio solution. And, down the road, even my counterpart at MSCI said that down the road, ESG is not going to be seen as a separate, bucket. It's going to be integrated into general investment and fundamental analysis of companies, such that it will just be a, integrated piece of information, and so that all funds will consider these factors.
Really important point I want to raise that I should have raised when I showed that slide earlier, because this is very, very important. We made a specific, deliberate decision when we came out with these two products to do broad-based ESG products. So when you get into the breakouts, you're going to see the competitors. You're going to be working with 3 ETF specialists on the competitors. A lot of the competition have very narrow products that are specifically based on carbon or no carbon. Right? So they're very, very narrow products. We chose not to do that. We wanted to cast our net really wide, appeal to as many people as we could. As a matter of fact, the CIO at Merrill had told one of our competitors, actually State Street, who has SHE, which is a gender diversity ESG ETF, again, very narrow segment, that come back when you have a broad-based ESG product. This person called me up very quickly and said, have you talked to Merrill yet? So, of course, we're all over that. But so that was a very deliberate decision. As Cara and Vince said, as we get more marketplace feedback, we certainly can offer ESG products that are more narrow in their scope. We thought that was a bad idea as we got into this market for the first time at Oppenheimer. So just know that it actually, we'll talk about how to integrate it into a model, but that was a very deliberate decision on our part. So you have very little competition. There's very few ETFs that offer broad-based ESG ETFs. So I just want to make sure that you're clear that that was an important, sort of progression that we made as we thought a lot about how best to enter this space.
The next question is, I'm presuming that Sharpe ratio. If Sharpe ratio improves the global data, why not use share on the ESG? Let me just clarify. It's not that it improves the data. When we do that screen, we end up with companies where we have more data on the company. So it wasn't that the data was changed by the Sharpe ratio, but the screen created companies that had better data. And we are going to be, we didn't need it for the domestic, but out of our shop at the revenue weight strategy, you're going to hear more about Sharpe ratios. We are creating Sharpe ratio screens, but our shop's going to stay with the revenue strategy. I know Sharon's going to have other type of things going on, but the products that we're trying to create are focused on the core part of it being revenue weighted, but we are going to add in some of the products we're coming out with a Sharpe ratio screen, particularly in the emerging market. It has had the back testing we've had on international markets is, we're still working with risk around some of the return data we're coming up with, but it's really remarkable, and it's not a new story. We were aware of Sharpe ratios as being a predictive, had predictive nature in it, but it wasn't, and I don't want to go into it because we'll spend too much time. It wasn't, we're unable to execute it. Now with the data we're able to do, and assimilate the data, we are now able to execute that as a very effective screen to then revenue weight a portfolio. And we think we've got some really good products that are going to roll out.
Last question. How does Wells Fargo make it screen?
They got booted. I guess they just got booted on, they fell into 4 and 5. They were in it. Now they're out.
And there's typically a delay. So just to finalize, it might be misleading. Usually the flag, the impact score gets elevated, so the controversy score immediately, which is real time. And then the index providers give the company an opportunity to respond. Hence, often a couple week delay in exiting, but they are out now. Yeah. And very much they take into account what, especially MSCI, takes into account how they manage risk. And so it's not just about how they're performing, but has the company taken measures into account immediately to address, and that will play a factor whether they are re-rated or kicked out.